G'day guys, welcome to another Lacking Financial Education episode 2. Today we're going to talk about the media's hysteria on basically, well, let's just put it this way, on the interest rates rising in absolute hysteria. And I gotta say, well, they've really not missed a beat on this one, okay? They have just gone in complete hysterics with the interest rates rising, where they make it seem like a 3.35% interest rate is like the highest they've ever had in ever. I mean, you've probably seen a lot of headlines stating, basically, highest rates in a decade because, basically 20 years ago, interest rates were a lot higher, funnily enough. So they're, trying to use things to state the data points and stuff like that. I mean, there's a few, if you look on Google images search and stuff like that, you get images like this where they show like 2 to 3 years of interest rate policy and suddenly, going up to 1.85 is suddenly a high point or anything like that. When anyone who actually looked at the history of interest rates, which we'll get to later, you also got some of these as well. You got the Sky cash rate here as well, stating it's, beyond high and stuff like that. And you can see here, like a lot of these media outlets are using this to manipulate people into believing, and they're never going to use this one, okay? They're never going to use this little bad boy from the RBA to highlight anything, okay? Because they just want to only focus on here, okay? They want to focus on this area, okay? They want to focus on how this is the highest point ever. They want you to ignore everything before this point because no one's going to care if they see this graph, okay? So that's how journalism and journalism generally works with finance, is they've got to make an absolutely boring and dry subject extremely exciting. And you can see here that if they showed this graph, everyone would be like, well, we've dealt with 7% rates before. Should be pretty normal for us. And that's pretty much it. It'll just shrug their shoulders and be like, well, it's not that high. It's actually quite normal in the scheme of things. So basically what media outlets have to do, and they know this because the general public lack financial education because A, they don't have the time for it and they hire someone to do it, and B, they know people only have so much time in a day, okay? So it's either they don't know it or they don't have the time for it. And that's what funnily enough, the two main client sets that we have is that they don't know it or they don't have the time for it. And that's what the media also utilizes, but in a very, very malicious sort of way. As you can see here, they've used it in a very malicious way where people will hype over and get, super scared of this old guy from the RBA, and they see, oh my God, it's going up like a roller coaster. It's going to be 7%. We could return into Paul Keating. And that's pretty much it. If you don't know about the Paul Keating joke, interest rates were up to 19% under him. And there's no way it's going to be the case in this ideal area or ideal world or anywhere at all. And you can see here, there are a few other things as well. Another RB8 rise. Oh, YouTube video and stuff like that, okay? Or obviously, I'm not sure who that's done by, but you can see here. All scary, little graphs being shown by the media. And this is what they have to do to sell any story in finance, is to any little increment of rate rise, they have to, make it like Godzilla, basically. When in reality, if you show them the RBA chart, it'll be like, oh, okay, pretty normal to me. And this is why, financial education is pretty important. Getting back to my main point, is because you need people to realize that this is just the fact of the matter that the interest rates do go up and it's nowhere back to normal where it was previously. And they're trying to target inflation, which is a big difference, well, compared to previously where they were trying to slow down the economy. Now they're trying to target inflation instead. Now, will this cause a recession? Maybe. Not terribly too sure, given the fact that Australia's GDP only went up by 0.5%. It's really going to be basically pretty much as if the GDP is going to be negative or the GDP is going to be slightly positive. It won't be like, negative 3%. It'll be like, negative 0.1 or positive 0.1. Whether we have a recession or not is very unlikely, also likely at the same time, depending on a few percentage points either way. But we're not focusing on that. But you can see here, the media has gone like doom and gloomy on this area, being like, a 5% interest, not 0.5% interest rise is literally, no one can pay their mortgages. Everyone's going to be on the street homeless, living in cardboard boxes. And, they don't leave any room for negotiation. Because with negotiation and debt, banks are pretty lenient with it, okay? Like, banks don't want to lose their loan. They don't want to lose money. They don't want their person who's paying their loan to go bankrupt, believe it or not. Now you guys may be sitting there going, oh, maybe the banks are like hawks, they'll pick your eyes out. They actually don't want you to go bankrupt, because if you go bankrupt and they take control of the property and then sell it for less, they lose money. They don't want to do that. They rather have you still be able to pay your interest or debt payments through this rough period, and then when it goes back down again, they still get their money back. Okay, they get a bit more money back. A lot of these banks are in the long game. They actually have good enough exposure to cover themselves over that period, to make sure, basically they have a well diversified loan book of mortgages where this mortgage will repay this year and stuff like that. They all are aware that they will take a bottom line to hit, because they're still getting some sort of margin for the long term haul, where they will eventually get the money back from you for the mortgage. They're not going to basically say, if you can't pay your mortgage for 1 month, that they're going to kill the loan completely, because they don't want to be in a situation where they lose their money and they have to try and recoup that 15 grand. Because with banks as well, they have insurance where the insurer will pay them to cover that debt. Lenders mortgage insurance, of course. They have that type of insurance for them, if that happens to them. And then the insurer will be after the bank for money. And that's why the bank doesn't want to be in this position in the first place. So we shouldn't get too hyped about these interest rates, because they are just returning to normal. And B, banks aren't going to foreclose on people. They'll let people get a discounted rate or get a lesser rate to continue to pay in their home. So don't stress, okay? But the media want you to stress. They want you to think that the banks are going to eat your home up and, kick you out in the streets in a day, because finance is boring. Now, let's talk about the next part, which is the interest rate, okay? This is the golden thread, the golden needle, the silver bullet that you need to say, hey, these interest rates aren't so bad. We'll just simply go down to all the interest rate changes for the RBA. You can see here, oh no, in May 2012, the scary 3.75% interest rates. Oh no, it's the end of the world. Now, you may say, hey, mortgages weren't that high back then, like the value of the mortgages, so that 3.75% could be a bit lower, but it gets a lot higher. And also, this is after the great housing boom as well, where we're at the moment, where mortgage rates are actually quite high. So you can see here that mortgage rates are actually quite high previously. Now, we'll ignore these ones in particular, because the prices of housing at this point, I believe, was a bit cheaper at this point. So 6% of, let's say, 240 grand house at that point, I think the median average price is a lot lower, isn't that much. But you can see here that a normal interest rate seems to be between 4 or 3%. So it's not actually abnormally high at all. It's actually in fact, we're actually just below average as an interest rate in the last 20 years. Now, are we going to see 7 or 6% interest rates? Unlikely. Probably 5% is probably the highest we're going to see. But 4 to 3% is actually quite normal. So we've been living in very abnormal times, as you can see here, as in the last 2 years, we've been actually, at 0.1%, which is extremely low and extremely abnormal. So we're just returning to normal at 3.35, most likely going to go up to 3.6. Some people are expecting a raise to 4% or even 5%. Overall, it's going to slow down the economy. And it's a good thing, because the inflation is getting a bit out of control due to the COVID cash that we had to give out. Or I'm not sure if we had to give out, but at that time it's very uncertain, so it's better to do more than do less. And that's what's occurred here as well. Now, the last thing here, I want to take you guys out of it so far. There are actually some valid arguments for the interest rate increases. And, you may think about, oh, okay, you didn't say it was all doom and gloom, but, what is the fears and things you got to consider? It's generally the fact that the interest rates rose quite a bit, okay, in a short period of time, where basically people who have fixed rates, their 2.27% loans when the interest rates are at 0.10 are going to expire and go up to 6%. Now, it's whether they have braced for the impact of what's going to happen with interest rate rises or not. That's going to be the main telling point. And a lot of people feel in the market that they have, and a lot of other people say that they haven't, and they're a bit worried about it. And, we're going to see probably in the next a few months or to the year, whether that fear is actually true or that fear is just, hey, I think we just over-egged the pudding on that one. I reckon there is going to be a bit of a market shock with the fixed rate loans, coming expiring. There is going to be a bit of a shock with it. I mean, your loan payment effectively, or doubling, I would say, but close. Nah, it would be doubling, because tripling is ridiculous. The interest rate tripling, but obviously your home loan rate would only double roughly, because you got a capital component as well. Overall, I'm going to say that's a justified argument, But stating that the interest rates are ridiculously high now isn't, and making doom and gloom off that. And that's what a lot of these media outlets are doing, where they're saying that, now it's 1.85 and acting like it's the highest rate ever in existence. But anyways, guys, if you guys enjoy these videos, like, comment, subscribe. If you just want a simple summary of this video, it's basically like this. High interest rates aren't necessarily that bad. These are normal interest rates. There is nothing high about these interest rates, and anyone trying to convince you otherwise with crazy images, which makes 3.35% look like, Mount Kilimanjaro, is being disingenuous. And also at the same time with financial media have got to make absolutely stone dry, boring stories exciting or scary or fearful, and generally fear bait and anger bait or whatever clickbait is much more better than actually explaining the facts. If you want to really get, your facts and stuff like that, go straight to the source material, get charts for the entire period. Don't go for charts for 3 to 4 months. I mean, you wouldn't measure a long-term, investment of anything over 3 to 4 months. You would measure it over a 10-year wingspan to see what it's really like. And that's what you need to do in this regards as well. If you want to know what the stuff I looked at RBA interest rates on Google search and also the RBA interest rate chart, as you can see in Google, to really explain my point that these rates aren't crazy. They're actually more for a return to normal. And I think a lot of people have been used to that 0.1% bubble. And that's what the hysteria that they're trying to build on is all about. Anyways, guys, have a great day. See you guys later. Peace out. Bye.